Good morning, everyone. This is the Office of Consumer Credit Commissioner's stakeholder meeting to discuss the Regulated Lender Administrative Fee Rule. My name is Matt Nance, and I'm the OCCC's Deputy General Counsel. I'm joined by several members of the OCCC staff, including Director of Consumer Protection, Huffman Lewis, Supervising Examiner, Carl Hubenthal, and Senior Paralegal Ginger Harmon, who's acting as our meeting organizer. We're holding this meeting through an online webinar, and I want to thank everyone for joining us. Getting input from stakeholders is a really important part of our rulemaking process, and these meetings help us make sure we produce the best rules possible. Our webinar platform is GoToWebinar. Some of you might be listening on your phones, some may be watching on your computers, and some may be doing both. For those of you watching on your computer, there's a window where you can submit questions. If you have technical questions about using the webinar, you can type them and Ginger will try to answer those. We're discussing a stakeholder information request that's available on the OCCC's webpage for recent and upcoming rules. On that webpage, you can see the request by clicking on the link for Regulated Lender Administrative Fee. If you have any comments on the stakeholder information request, you can go ahead and type those in at any time and I'll be getting to those. And if you're on a computer with a mic, there's a function allowing you to raise your hand and then we can let you make a comment verbally. We are talking about the rule that sets a $100 maximum administrative fee for loans under Chapter 342, Subchapter E of the Finance Code. In 2013, the Texas legislature passed an amendment allowing the Finance Commission to set the maximum administrative fee by rule, and that same year, the Finance Commission adopted its rule setting the $100 maximum. A group of lenders has requested that we increase the maximum administrative fee. And before we move forward with proposing any rule amendments, we wanted to gather information from stakeholders about the fee. The idea of this information gathering is to make sure if we move forward with a rule amendment, that we have an appropriate factual basis for any amendment. Our meeting notice lists our questions for stakeholders, and this slide kind of summarizes the topics we're asking about. But we're interested in the amount of costs. Can lenders provide dollar amounts for the actual administrative costs of closing a loan? And how have those costs changed since 2013? We're interested in the scope of costs. So how can lenders show that their analysis is limited to the administrative costs of closing a loan, as opposed to post-closing amounts more appropriately captured by interest paid to the lender? We're interested in whether any cost increases are offset by efficiencies. So have any costs gone down since 2013 due to increased efficiency? And are these reduced costs outweighed by other costs that have increased? We're interested in benefits and drawbacks. What would be the benefits and drawbacks of amending the rule at this time? And any other information that stakeholders have relating to this rule. So with that, I have summarized the information request and now we're interested in hearing from y'all. So I will open things up to comments. Again, there are two ways to provide your feedback through this webinar. First, you can type your comment out and send it to us through the webinar's question feature. Or if you're on a computer with a mic, there should be a function allowing you to raise your hand. So Ginger, do we have any written questions or comments through the webinar at this time? Okay, we have a hand raised from Deborah Poland. So Ginger, would you unmute Ms. Poland?
Good morning.
Good morning.
This is Deborah Poland. Thank you for the opportunity to provide comments today and hold the stakeholders meeting. I represent the Texas Consumer Credit Coalition. The TCCC is a member-driven organization of community-based lenders that are licensed by the OCCC and regulated in accordance with 342E of the Finance Code. Our members include companies that have served Texas borrowers from stores across the state for over 50 years, and some that have just expanded into Texas over the past 5 years. The coalition's mission is to promote the increased availability of quality consumer credit to Texans that is carefully underwritten for an ability to repay and provided at fair and reasonable prices. In 2013, Senate Bill 1251 amended the Finance Code to give the Texas Finance Commission the express authority to review the administrative costs associated with the origination of a loan and to set a maximum alternative fee. When I started on this issue in 2013, there were two major lenders in this market. Since that time, several companies have expanded into Texas to create a more robust consumer lending environment that benefits Texas borrowers. As was stated by y'all in the Texas Register's preamble last time this rule was amended, future amendments were certainly contemplated. I think I'm going to paraphrase, but the preamble talked about adjustments from time to time and review of expenditures. And while we're here today to discuss the importance of ensuring that our state's framework supports lenders' investment and promoting successful consumer outcomes, I'd like to just briefly mention how our members have continued to support Texas communities during the past 18 months. COVID-19 presented a plethora of challenges to our industry. Member companies made significant investments to keep both customers and workers safe. And our coalition led a collaborative effort this past legislative session to seek legislation permitting a licensee's employees to work from home under appropriate circumstances. During the pandemic, our members continued to meet important consumer credit needs. We proactively reached out to our borrowers. We actively worked with those who faced COVID-19 related disruptions to assist them the best we could. And to that end, these efforts, along with the COVID-19 relief payments from Congress, resulted in a very successful transition for our borrowers during these difficult times. That success demonstrates the value of the relationships we have with our customers and the foundation that is built in the beginning when they're seeking credit. This foundation benefits our borrowers by promoting household wealth, supporting community economic growth, and ensuring that our borrowers have access to affordable credit when planned or unplanned life events arise. And success for our borrowers equates to success for our members' businesses and therefore the Texas economy. There is simply no financial incentive to place a borrower in a loan they can't repay. Origination costs for lenders operating under 342 include, but are not limited to, labor, software, hardware, office space, utilities. Without exception, all of these costs have increased significantly over the past 8 years. And whether we're making a $500 loan or a $5,000 loan, those operating costs are still the same. And as origination costs continue to rise, because of these types of investments, issues critical to consumer protection have also increasingly required our attention. Efforts by lenders to safeguard financial privacy, to combat identity theft, and to ensure cybersecurity have required continued investments and require continued investments and today and tomorrow. Without exception, TCC lenders work hard on the front end of each transaction to ensure that the loan terms are appropriate, affordable, and responsibly offered. This origination investment is reflected in our low default rates, which average in the single digits. And based on the foregoing, we support the request to revise 7 Texas Administrative Code 83503 to more realistically reflect the costs incurred by lenders today. Thank you for the opportunity to present these comments. I'm happy to answer any questions.
So thank you for those comments, Deborah. I really appreciate providing that information. This context is really helpful for us in making good decisions and ensuring that we have a good factual basis for our rules. I did have a couple questions for you, if you wouldn't mind.
Sure.
So have the lenders in your group conducted studies to quantify these costs and how they've increased since 2013?
They have, and let me give you a little background. As you well know, the lenders that were in place, the 2 national lenders that were in place in 2013 that actually worked on the legislation at the Texas legislature have morphed into different companies at this point. So the data I gathered from my members really looks at 2015 to 2020. I'm in the process of getting the rest of 2020 at this point. But we're looking at 5 years. And without exception, 5 years ago, the lenders who were not here in Texas, but the lenders who were here 5 years ago had an origination fee that they can quantify that was more than $100. And over the past, the way we came up with this original request of $200 was we looked at all the studies. It's difficult to compare the studies because one member, a significant member, did a time study to ascertain how much of the expenses should be allocated. It's like a Nike time study. How much of the expenses should be allocated to origination. Others did them in different ways, but we looked at how rents, hardware, software, et cetera, had increased over the last 5 years. And we picked a number that was not nearly as high as the highest. And we're probably in the 20th percentile of what I got back. So that's how we came to our number. But yes, we do have we do have numbers that we'll be submitting in written comments. Does that answer your question, Mr. Nance?
Yeah, we're interested in seeing those submissions of those studies and the information that came out of those, because yeah, we're really interested in putting some numbers to this. You mentioned the pandemic. And of course, we've been closely following the issues around the pandemic relating to safety in the workplace and remote work from other locations. And so I was going to ask you, you had talked about office space. Have the members of TCCC increased any decreased costs or experienced any decreased costs from remote work outside of an office space?
No, sir, not that I'm aware of. Our efforts toward remote work had nothing to do with eliminating our customer community-based facilities, because that's our model. It was merely to accommodate the employees and customers that didn't want to, we had to make changes in the workplace, but that also required some people not to be there, at the same time. So if anything, it was more expensive because we had to set up those firewalls, et cetera, to keep information safe. So this was not on, from the TCCC perspective, there was no decrease in office space associated with remote working.
Okay, well, yeah, I'm interested in, getting more information about that, because I, would think that businesses would move to some of, and really, I'm interested in generally over the last 8 years, the move toward more digital and electronic or online processes and the effect that has on costs. Because my intuition would be that lenders select those processes partly because they reduce costs. And so if you can provide some information, again, to quantify that, we're really interested in hearing about that.
Of course, Mr. Nason, but remember, the lenders that I represent have a model of community-based lending. And there's a digital component, but basically the model here is being in the community. And that's what these businesses are built upon. And yes, there's been an expansion of online lending, but I'd argue that online lending many times is not regulated by your agency. So, and the costs associated and the fees charged too, and I'll give you examples in my written, the fees charged are much higher than they are on the regulated bids, because we're subject to the statute.
Okay. Another piece of this I wanted to bring up is renewals and refinances. So although there are limits in the current administrative fee rule based on timing, either 180 days or a 1 year limitation, depending on the type of transaction, it is possible to charge this fee again in connection with certain renewals or refinances, provided the lender complies with some timing requirements. So that's also a part of the context for this issue. So Deborah, do you have a sense of the costs of refinancing a loan and whether those are similar to the costs of the initial closing? My intuition would be that it's a much lower cost to refinance an existing consumer, but is that something that your members have looked at?
We have not looked at it in this context, but I'll be happy to provide that information
Okay.
at a later time.
Okay. Okay, Huff, Carl, did y'all have any other questions for Deborah?
You know, I don't have any specific questions at this time, but the cost study information would be very helpful for us to see that, particularly, you know, the 5 categories of costs that you believe are applicable to originating a loan, and how you identify those costs and the activities of originating the loan. How are those activities coming out of the cost? Like, what's your methodology for allocating those costs? That would be helpful for us to see that.
Yes, sir, I'll provide that.
Okay, thank you, Deborah. We have a few written comments I wanted to read out. We have, and looks like these are just kind of providing commentary. Again, if these folks would like to provide verbal testimony, feel free to raise your hands. But in the meantime, I'll just read out the comments. We have from Steve Perkins: the $100 administrative fee should only include labor, software, hardware, and office space related to closing the loan and providing money. Lenders seem to be saying that those costs have doubled in the last 8 years. Can lenders show their costs in 2013 and 2021 to demonstrate the need for doubling the fee? We have another from Ann Bador. Based on the comments, they appear to be attributing multiple costs not uniquely associated with the specific costs of a particular loan. How much of these costs are part of the overall cost of doing business versus the very particular costs of a particular loan? Also, these businesses offer multiple products. There is a concern that there could be attempts to subsidize other new products that they plan to sell to the same customers through this fee. So yes, those are all good topics to bring up. Those are issues that we are interested in getting feedback on. And kind of as a, like I said, we're also interested in this issue of refinances. Kind of a different way of asking that would be, are the origination costs to refinance a loan less? And are the origination costs to making a loan to a former borrower less than making the original loan? Okay, we have a couple hand raises I wanted to get to. And the first one is from Karen Neely. So Ginger, if you could unmute Ms. Neely.
Okay, thanks. This is Karen Neely. I'm General Counsel for the Independent Bankers Association of Texas. And as you all know, we represent the community banks in the state. We will be gathering hard data to provide to you all. I don't have latest data at this time, but we will be providing this. We did collect some very explicit information in order to comment to the CFPB on the small dollar loan. And my basic comment to you all today is that where we're coming from is looking at the cost of making loans based on the factors that were identified by the Federal Reserve. For many, many years until 1998, it actually published a functional cost analysis that identified the actual costs broken out by various categories and various types of lenders for different kinds of loans. And those factors are actually specifically identified right now in 7 TAC 12.32, the Department of Banking loan fee rule. And that identifies the average cost as including the cost of taking an application, obtaining necessary reports and documentation, review of credit reports, analysis of the loan proposal and the prospective borrower's ability to repay, preparation of documents, the loan review before it's closed to make sure that all of the various compliance issues are satisfied, and the closing activities plus a reasonable overhead factor. So we will be collecting those. Some of them are very clearly identifiable. They're hard dollar amounts from, you know, Laser Pro or whoever is doing their documents, the cost of actually booking the loan onto the data processor. So those are very identifiable costs. We'll be collecting that and then providing that to you. But I did want to provide you with that information as to what the Federal Reserve, as a primary regulator of banks, had identified as the cost of making a loan.
Okay, well, that's really good. Yeah, that sounds like good information that we would want. I think we are also interested in, you know, whether there is a change from 2013 to the present, and again, whether any of these, whether the shift toward more of an online or electronic presence has reduced any costs. So if your members have done any analysis of that issue, we're interested in learning that as well.
Yeah, we'll check on that and provide that information as we gather it. Again, similar to Deborah Poland's comments, the independent bankers are very much community-based. They're primarily physical branch-based, and so their customers come into the institution, to the branch, to actually apply for and obtain their loans. Now, that's not to say that there's not online loan origination. That is definitely something that is available, and of course it varies depending on whether the bank is connected with a fintech to provide different kinds of products, or whether they are indeed pretty much physical branch oriented. So there's a lot of variance among institutions, and we'll collect that data and provide it to you to the best of our ability. And we thank you for this opportunity to provide input.
Okay, great. Okay, we have another written comment I wanted to get to. This is from Steve Perkins. According to OCCC 2020 report, 342E loans tripled from $1.4 billion in 2014 to $4.5 billion in 2019. How have companies used that increase in revenue and their profits to reduce costs and improve efficiency, which should lead to lower costs to borrowers? Good question that we are interested in getting feedback on. Okay, we have, I believe our next hand raise is from Chris McKinley. And so Ginger, if you could unmute Chris McKinley, that would help.
Mr. McKinley, you've been unmuted. You can go ahead with your comments. Mr. McKinley, thank you for letting us know that the mic is not working on your end there, and we are just going to go ahead and go on to our next hand raise, and we will come back to you to see if we can get that mic working for you.
Okay, looks like the next one is from Ann Bador. So Ginger, if you could unmute Ms. Bador.
Ms. Fedor, you've been unmuted. You can go ahead and unmute yourself on your end and you should be able to make your comments. Ms. Fedor, your mic is live. So whenever you are ready, you can go ahead and begin with your comments. Thank you for letting me know, Ms. Fedor, that you were having some trouble with your microphone as well. My suggestion is to try and get out of the webinar and then come right back in. Sometimes that helps to just reset your microphone. But we'll go ahead and go on to the next comment or hand raise, and we will come back to you. Mr.
Okay.
McKinney is also coming back in to go ahead and make his comments.
Okay, we did have a follow-up, and Ms. Neely, if you could stand by. I think we had a follow-up question for you. We are also joined by our Commissioner, Leslie Pettyjohn, who has been listening in and wanted to join us and ask a question for Ms. Neely. So Ginger, could you unmute Commissioner Pettyjohn to ask the question?
Yeah, I think I should be unmuted. Can you hear me, Matt?
Yes, we can.
Okay, great. So Karen, thanks for those comments. And I remember some of that information about the cost per loan that the Federal Reserve used to publish. You know, my recollection is those costs were, you know, very exclusive to banks and really didn't seem to fit the same model for non-banks. Just a different delivery model, different mechanism and infrastructure type situation. But I think it's helpful. But I wanted to ask you about this section that we're working on in 342-201G and how banks are you know, what's the how are banks using? Are they relying on 342-201G and the Finance Commission rule currently for the basis of charging a type of administrative fee? And I'm just looking for some more information about how banks are particularly using this section. Can you give me some insight on that, please?
Okie doke. Yeah, thanks for that question. To tell you the truth, it varies all across the board. So there are banks that charge the full $100 on the small dollar loans. There are others that still charge the $25. There are banks that have it on a sliding scale. And so it's really all across the board. I can't tell you that it's all one way or the other, but it is definitely a fee that is helpful so that banks, which do have a different overhead structure, as you note, are capable of making small dollar loans without candidly going in the hole. We did do some analysis for the CFPB small dollar loan that concluded that there was a certain break-even point that I suspect is significantly higher than it would be for, let's say, a finance company to make the same loans. So there are different factors in play, and absolutely, it's not monolithic in terms of what banks do on their fee structure. Does that help?
Yeah, no, I can understand that, you know, the fee structure would be different by banks, but just generally, again, it was not my understanding, especially from our previous work in this section, that banks were relying on this particular rule provision for their administrative fee structure. So that's new information to me. So I'm going to go back and kind of review some of the past history about that. But I understand that they would vary, of course, by institution. But yeah, I appreciate your follow-up. Thank you.
No, quite a few of them do rely on the $100 fee. But again, it's going to depend on competition and a variety of other factors. We will be gathering the data to try to provide you with some hard numbers on costs. And then I'm sensing that you would like to know whether they're using the full amount as well. And we have to be very sensitive about how we do that, because as a trade association, we can't, we have to keep it pretty anonymous so that we don't violate the antitrust laws.
Of course. I guess I thought that most banks were relying on 303.017. But maybe you've got some that are in the higher rate structure that are really relying on 201G. I guess that's where my confusion was. That's where I thought that the banks were deriving their authority from. Because I guess most of my past recollection in dealing with these costs, like the types that the Federal Reserve published, really were more in relation to 303.017. So that's why I'm just trying to get clear in my head, kind of what we're doing with the banks versus the non-banks. That's where I was coming from.
Yeah, understood.
Right. Thanks.
Yeah, Karen, if I could kind of ask a related question that question made me think of, it's so Chapter 342 applies to loans with an effective annual interest rate greater than 10%. So that's the class of loans we're talking about. And our agency, you know, our licensees, or you don't need a license to make a consumer loan with an effective annual interest rate of less than 10%. And Chapter 342 doesn't apply to those loans with rates under 10%. So while this is a little bit outside of my area of expertise, it was my understanding that banks making consumer loans with rates of under 10%, there are separate laws that let banks charge a reasonable fee. And so it was my understanding that for the loans with rates under 10%, that authority is what the banks were relying on. And that's not exactly what we're talking about here, but I think the commissioner's question is closely connected with this question of whether the rates are over or under 10%. So that's another piece of this puzzle that I'd be interested in knowing more about.
Yeah, and again, we have to be sensitive to gathering the data. So we will be, but there are definitely a lot of really small loans that are going to be made at a rate of over 10%. At the same time, with rates dropping so precipitously as they have, there are quite a few consumer loans that are made at below 10% by banks. But it's all over the board. And again, it's going to depend on the type of loan, the type of collateral, et cetera. So there are a number of factors that are in play there.
Okay, good. Okay, before we get to our kind of pending hand raises, there was one more written comment that I see that I wanted to read out. This is from Stephen O'Banion. My question would be, what is the benefit of doubling the fee now? With the data we have from this industry, revenue is up and operating costs are down. In a time when families, businesses, and communities are struggling financially, this does not seem to be the time to add even more costs to loans for consumers. It would be helpful to see more data on the reason why the increase is needed. What are the benefits and drawbacks of amending the rule at this time? Oh, I'm sorry, that was from Stephanie O'Banion. Quick correction to the name. Yes, that comment, good questions. We're interested in getting information on all of those. Okay, I think we can go back to our pending hand raises. So if, Ginger, if I remember right, we had Chris McKinley, who is back and ready. Could you unmute Chris McKinley, Ginger?
Can you hear me now?
We can, yes.
Oh, thank goodness. You know, I am technologically challenged, so I appreciate y'all's patience there. You know, I am a member of the Deborah Poland's Association, Landmark Financial. We have 25 branches in the state. And I just wanted to, you know, briefly just touch on a couple of the issues or questions you were asking. And, you know, that obviously will be followed up in the data. Number one was the remote from home. And that was basically designed to allow us to have the continuity in servicing consumers when we had to close a branch. And that was part of our COVID protocol. Our typical branch has 3 people in there. And if one person tested positive for COVID, we would have to close that branch and have the other staff, you know, do the appropriate amount of quarantine. So really, you know, that was strictly a function to be able to facilitate our operations during COVID protocol. It was really never intended to be any kind of an efficiency standpoint. And to Deborah's point, we actually had to invest in additional resources to make that happen and ensure that we stayed within all the appropriate privacy guidelines and consumer protections. The second part, which is, you know, again, a good question on the efficiency thing, what we'll be able to provide is the data points I'm going to use are when it comes to online lenders and the way that they process and their efficiencies is with the American FinTech Council members who operate at a 36% APR cap, which is, you know, currently well above where we operate in Texas. But the average FICO score for those members is around 700. Our average FICO score is around 615. And what you see is even though we have a significantly lower average weighted FICO score, our consumer success experience is significantly better, where we're in the mid-single digits, and many of those online lenders that are operating at the 36% cap are in the double digits. So the moral of the story is you know, while we can use technology to help us manage our business better, it is not necessarily a function of cost reduction, because we see that the approach that the online lenders use significantly reduces their ability to take on the same kind of risks that we do. And to the point I made earlier, our consumer experience is considerably more successful. And that's the point with this particular type of product and the markets that we serve, is just the critical need to make the investments and the time up front to make sure that, you know, it is going to be a successful outcome for the consumers. And again, to Deborah's point, you know, there just simply isn't a financial incentive for us to put somebody in a loan they can't repay. So that, you know, those data points will be brought out. And one other thing to kind of keep in mind here, when we're evaluating and allocating our cost per loan, we on average only end up booking 1 out of every 4 applications. So the other 75% of the applications that the members are putting significant upfront effort into in underwriting and evaluating the borrower, you know, those represent costs that are never recovered in there. So again, we're generally only booking 1 out of every 4 loans. And you know, again, I think we'll be able to lay out the cost approach, but there's just simply certain aspects of the community-based model that, you know, cannot be streamlined with online processes. Some you can do an application online, but still there's a lot of hands-on costs that's unique to this business, and is an extreme benefit to consumers, because at the end of the day, that's what the priority has to be, is a successful consumer outcome. And you want to make sure that your lenders are investing the right amount of time and investing the right amount of resources to make that happen.
Okay, that's really good information. Thank you. And yes, we are definitely interested in you know, getting comments with the information you've described. And yeah, I hear you about the increased costs. I think one thing it's our understanding of this fee that this is a fee designed to compensate the lender for, you know, the costs of closing our particular loan. So we're interested in the information that's provided, an analysis of how lenders can show that the costs they're describing are limited to the cost of a particular loan. So that's information we're interested in getting. The kind of general lender overhead, or, you know, overall costs of doing business, I think are more appropriately captured by the interest charges in connection with the loan. But
yeah, and one other point was on the new extensions of credit to existing consumers. As a general rule, the same amount of effort is going to be placed in any subsequent credit request with an existing consumer as there was in the original one. You're still going to do a full underwriting. You're still going to look at a credit bureau. You're still going to do all the things that you would do basically as if it were a new customer, because simply things change. So there's really not any shortcuts, you know, significant or material shortcuts that a lender can make on any subsequent new advance of credit with an existing consumer.
okay, yeah, that is a good point of information, and definitely something we're interested in learning more about in written comments. Okay, Ginger, was Ms. Bador able to log back in? Are we ready to reattempt Ms. Bador?
Yes, I'm going to go ahead and unmute her now.
Okay.
Ms. Bador, your mic is unmuted. If you can try to.
Yeah, I'm. Can you hear me?
We can. Yes.
Great. Thank you. Thank you so much. Sorry about the little problem before. I didn't have my settings quite right to participate. I just want to thank you all so much for having this conversation. I think a lot of really important issues are raised. I want to just highlight a couple of things. One thing caught my notice. I think one of the speakers referenced a cost template that was last reported in 1988 as a model for how costs should be calculated. And I'm really concerned if that's the standard that we're going to be looking at for this. You know, 2021 is very different from 1988. The costs are very different. So many systems are now automated, and it's just it's a whole different model. And I really want to encourage this not to be a backwards looking exercise, but actually a forwards looking exercise, because we're not changing the rates for loans between 2013 and 2021. We're changing it for 2021 to 2026 and beyond. And so technology is evolving at a huge rate, and though some of the people who have spoken have indicated that their model is not online, for those companies that have public presence and are publicly traded, there's been substantial touting of increased online presence and online engagement. Many of the fintechs cited are also 342E lenders and licensed in the state. Some engage in bank relationships, but a number also lend through 342E. So I think it's important that when the commissioner and the commission is looking at this issue, that you look at not subsidizing the least efficient business models. That should not be the effect, but rather taking the most efficient approach and using that as the model, because I think, it's all about creating fair prices for consumers. And there's not a lot of data in the market that supports that the cost should be raised. In fact, people point to labor costs increasing, but wages haven't increased substantially in the last couple of decades. The minimum wage is still the same. And, there are choices businesses may make, but a lot of these costs, and a lot of these costs have been automated. One of the businesses touted a new AI underwriting system. And so given that these costs are becoming much more streamlined, that these systems are investments that are not unique to Texas consumers, but to everyone they're serving in the country, because many of these lenders serve customers in multiple states. And if you look at the APRs in Texas, which includes both the interest and the fee, Texas is above the median compared to other states. And so looking at the vibrancy of the market, at only increasing inefficiencies for technology moving forward, it gives one pause about what the rationale in this moment is to ask for such a substantial increase, essentially 1,000% increase from what was in 2013 prior to this uptick to $100. So I just want to put that out there as food for thought. In a very successful industry, it's hard to understand why such a substantial fee increase is needed. It appears that I would be concerned if this were a backdoor way to raise fees, raise the cost. Essentially, I think that's a really top line concern associated with this. So just some ideas and thoughts. And the other thing that I want to put out there is I'm not sure that it's appropriate for any COVID-19 related expenses to be included in any assessment of costs, like specific costs. And there were also cost savings, with people working from home. But that's such a unique thing that happened. I'm not sure that should be used. I'd be curious in people's thoughts, should such a unique outlier event be used in doubling the origination costs for the next 6 years for these loans?
Okay, those are really good points. Those are things we're really interested in gathering information about. And you raise a really good point that this rule would be effective for future years. So if lenders, know or have studied or have forecasted their costs for future years, I think we're interested in knowing that. I am still interested in knowing what has increased since 2013, because because that has happened, there is some hopefully what stakeholders will produce will be some concrete data that could provide us with good facts rather than just relying on forecasts. But yeah, you raise a really good point. This rule would not, it would be effective for future loans. And so sure, it would be great to have some information about forecasted costs into the future. Okay. We have another written comment from Steve Perkins. According to OCCC 2020 report, there were 795,552 Chapter 342E loans in 2019. So doubling this fee could add $80 million in costs for borrowers. What benefits do consumers receive from doubling the fee? Okay, we have Mr. McKinley has raised his hand again. Mr. McKinley, did you have additional comments? Ginger, could you unmute Mr. McKinley again?
Sorry about that. Yeah, I just, just want to touch base. I understand Amador's, view of the online, but it's really apples and oranges relative to the markets that we're serving there in Texas. And the online lenders are not serving the average FICO score lenders that many of our members do serve, and are serving them at a better success rate than the online lenders. So there's a big difference between making loans to an average FICO score borrower of a 700 versus a 615. So, while clearly they are licensed under our statute, and there's a question to whether or not that total volume. I'm unclear of how many of those lenders are actually making loans under there, because we've seen in other states where they've licensed in the state, but they're still maintaining their bank partnership. But again, it's apples and oranges, and that's not to totally discount the whole thing out. But I think it's important in your all's analysis that that kind of perspective remains. That it is different markets, it is different approaches, and it is going to be an apples and oranges analysis if you look at that.
Okay, thank you for that. Looks like our next hand raise is from Ken Kenyon. Ginger, could you unmute Mr. Kenyon?
Mr. Kenyon, in order to unmute your audio, you need to enter a PIN that has been sent to you. I'm going to go ahead and give you a couple minutes to enter your PIN and start your audio.
Okay, and if others would like to use the raise hand feature or enter any written comments, now would be a good time to do that. Again, we'll try to get to all hand raises in the order that those come in.
Okay, it looks like Mr. Kenyon is ready to make his comments.
Good morning. Can everybody hear me?
Yes, we can.
Oh, great. Thank you. Just a couple of points I'd like to kind of run through. This is not a 2 or 3 minute drafted comments. So, but I would point out, Mr. Nance, that in your discussion about having the branch expenses should be allocated to. So how do we reconcile the fact that our employees spend more than 50% of the time originating and closing loans? So in that physical location. So I believe now, is it the entire amount? Probably, no. But is there some amount that can be allocated to that I think would be appropriate in this case? Or at least appropriate to take a look at. Additionally, there were some points made, I believe, by Ms. Madure about the possibility of cost going down with the digital revolution. Well, one of the things with the digital revolution that is created is an affiliate cost and an aggregator cost. And those prices are expensive. And when I say aggregator, I'm talking about Credit Karma or Lending Tree or an affiliate. In addition to those expenses, Google is not cheap to move you to the appropriate spot. And so there are expenses that we never thought would come up 10 years ago, that we would never have. So we thought, moving to the computer system was the greatest thing since sliced bread. And yes, it has, and it's created a huge amount of data, which is used by the companies to make things better for the consumer, to help market and to help with the consumer that they are charged the appropriate rate. Now, one lady mentioned about the fee, that we would be selling some new products inside the fee. I'd like to point out that we are strictly governed by the OCCC, and we can only charge what's allowed in the statute. So there are no other products that we can sell unless it's statutorily authorized or authorized by the commissioner. And I think those are very limited cases. Also, Mr. Nance, you talked about former customers and renewals. So a former customer is just like a new customer. So you have the affiliate cost, you have advertising cost, you have the cost of the branch, and you have the underwriting cost, which every single loan that my specific company does, and I believe our association does, is every loan gets a look at and is underwritten. And it's underwritten and it is looked at for whether the customer can afford it. We look at their bills, even down to the cell phone bill, to see if they can afford to pay our loan. And as Chris so duly noted, that an unhappy customer doesn't help me or them, and we want to create a success story for the customer. Our operating costs, once again, it kind of goes back to the digital. Our operating costs have not come down. They're going up in almost every situation between that piece of the branch cost. Everything has gone up, from benefits, compensation, once again, affiliate costs that have gone up substantially. And so those costs have increased. Also, I would like to point out that work from home is not cheaper. It's actually more expensive, because we have to get a computer that a employee, a team member, can take home and work from home. So we have to build that computer. We can't buy a $900 iPad and say, here you go, have at it. It's a pretty substantially built piece of hardware and software to protect against the hacking and the theft of data and all of the things that go along with security functions. In addition to that, we don't get a break on paying the rent. And there's people lined up, mad at landlords for not waiving rent. Well, our landlords, they don't waive rent for us. So we still have to pay rent. We still have to pay the lights. So it's more expensive to have someone working from home than working in the branch. So I just wanted to point that out. And then additionally, my last point, and thank you for your indulgence, is that I believe, and our trade association believes, that by equating this origination cost, that it will enable our trade association folks to serve more Texans, and to serve more Texans, more subprime customers and near prime customers, that it will allow us to serve more, and even to the point of down in the credit desert, that this fee will allow us to reach a little deeper in the desert. And once again, I think our average loan is about $6,000 to $7,000. But we have customers that want $3,000, and that's technically in the desert. And and you have to tighten up your underwriting accordingly, and that's what created the desert. So this will help alleviate some of the pressure in the credit desert. And other than that, I think that's my last comment. So thank you very much for the time, and I apologize for taking so much time.
No worries, Mr. Kenyon. That's really helpful information. I did have one follow-up question for you. You talked about affiliate costs. I wanted to see if you could explain what you mean by affiliate costs and who these affiliates are and what they are charging money for.
Primarily lead generators. So they're in addition to, so an aggregator may be a Credit Karma, and they're just bouncing the loan to you. An affiliate is more like a lending tree where the customer gets shopped loans and shopped loans from other companies as well. And it's really in the digital marketing area with the companies that we're doing business with to sort of increase our visibility on the web. But no, it's not an affiliate that makes loans or anything like that.
Okay, that's good. Yeah, we are, so you raise a lot of interesting points. We're interested in getting more analysis of this. You raised increased costs of advertising through Google and lead generation. Those are costs that I have some trouble allocating to the particular cost of closing a particular loan. So I'm interested in, again, this kind of goes to what costs are increasing that supports this fee and what costs are excluded from the analysis. But I would be interested to know if, like, part of the justification for this increase is increased costs of advertising and lead generation. And that's not normally something I associate with the cost of closing a particular loan. And if we are including that cost, that would mean that, you know, a consumer who pays that fee is kind of subsidizing the cost of advertising to all the consumers who see the advertisement on Google or for whom some sort of lead is generated. So we're interested in getting more information about that. Again, this goes to kind of the scope of costs, how costs are allocated and which costs are excluded, because understanding which costs are excluded from the analysis is also as important as understanding which costs are going into the analysis. Okay. So I'm not seeing any other questions or hand raises at this time. I do want to make sure we've given everyone an opportunity who wants to type out a written question or raise their hand to make a comment. If you have a longer written question, feel free to type out something quick, but otherwise we'll plan on wrapping this up pretty soon. I don't see any hand raises, don't see any other written questions. If you have a longer written question or comment, go ahead and type out something short so we can see that and know to wait a moment. But other than that, I'm going to wait for 1 minute just to see if we get any other hand raises or written comments.
We have a few hand raises.
Oh, good. Okay. Yes, I see Mr. McKinley and Ms. Bador. So Ginger, could you unmute Mr. McKinley?
Yeah, so as we provide the information, and again, I just want to address one of the issues that was raised about employee cost and the minimum wage. Members of our association do not pay their employees based on minimum wage. They are, finance professionals. We operate in a very competitive market. So the notion that minimum wage has an influence on what our costs are, it's going to, as far as labor costs go, it's going to be more of competing for those financial services professionals in the market in there. And so again, we'll be able to show that. I just want to make sure that we're not referencing a labor cost point that really has no application to what we're seeing in the industry.
Okay, good, thank you. Ginger, could you unmute Ms. Bedore as well?
Hello, can you hear me?
Yes.
Okay, perfect. I also wanted to just raise another issue that I don't think has come up at all, which is that a lot of these businesses sell ancillary products alongside the loan: credit life, credit disability, credit unemployment insurance, and it's very important, that's and shouldn't be considered part of this fee. Any time that the employees are spending talking about those products, is that considered part of this, and shouldn't that be disaggregated from any other costs, that may be specifically associated with the loan, or costs related to underwriting those insurance products or other things?
Sure, that's a really good point. And yes, again, that is something we'd be interested in kind of seeing some analysis on. If a lot of the employees' time is spent on selling an ancillary product, and the business is including some sort of premium or fee for that product in the as part of the loan principal or amount advanced, that would be good information to know about. Okay. So do we have any other, not seeing any other questions or hand raises? Again, I just want to make sure everyone gets a chance. I'll wait 30 more seconds just to make sure we've gotten everyone. Okay, well, thank you everyone for participating and for joining us. That was a really great discussion. I really appreciate it when we can have good participation from stakeholders in these webinars. Rule updates are available on our website for the OCCC's webpage for recent and upcoming rules. Oh, we have a hand raised from Mr. Kenyon again. So Ginger, could you unmute Mr. Kenyon?
Thank you, Matt. I'm sorry I couldn't. I just got it in under the wire, but thank you for taking my last comment. As far as ancillary products, the three products that Ms. Bedore mentioned are all regulated by the state on the price, and it's a very nominal amount, dollar amount of coverage. They're all guaranteed coverage, and actually they are enrolled into the master plan, master policy. And once again, I mean, I know from examinations they are really check refunds and so forth, and we as far as the ancillary product, once again, it comes down to whether the consumer wants it or not. It's the consumer's choice. It's not our choice. And I think to break it out of what my company has done would be infinitesimal to figure out the 5 minutes or 10 minutes or 15 minutes based upon the questions that the customer may have, or longer, to break that out of our cost. Thank you, Matt, and that does it for me.
Okay, thank you. So again, I really want to thank everyone for participating. This was a really good discussion. As I was saying, the OCCC has a web page for recent and upcoming rules, and any updates we have on any rule actions we move forward with are available on that page. We are accepting informal written feedback on this issue until 5 p.m. next Friday, August 6th. Please email those to me at rule.comments@occc.texas.gov, which is our email address for rule comments. I want to thank everyone for attending. Again, really good discussion. Please be safe out there, and we will see you next time. Thank you.